Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to do what turns into our daily Twitter news feed, it seems like. But we're going to see what's going on Twitter. I like to see what people are talking about, look at the data, at least that people post. And obviously, I'm going to interject a bunch of my financial opinions in with it. So let's just dive right into it. Again, if you want to follow me, it's at finding_finance. And if you want to join the website, you can join our community at finding-value.com. So we've got Goring and Rosenzweig. It says, new research. In 2018, we predicted the Permian would peak in the mid-2020s. Now we believe it could happen a lot sooner. We uncover what is driving lower productivity in the shales and why recent trends could predict field exhaustion across shales. And he's got Hubbard's peak is here. And that's pretty a pretty big statement. If Hubbard's peak is here, we should see, well, at least, so I used to follow a lot of the guys in the peak oil camp. Colin Campbell was one of them. I used to also follow Richard Heimberg and Matt Simmons, a bunch of different guys back in the mid-2000s. They were talking about potentially some of these fields peaking, some of the big boys out in Saudi Arabia and the Middle East. And really, that's where the majority of the oil came from, at least in the add-ons, and where the bulk of the production is even today of the low-cost, high-energy return oil. But the shale oil came into play. We've also had technological progress. And we really, I'll say, covered the gap or the holes of any oil shortfall from the shale region in the United States. The United States is the largest producer of oil. OPEC is not the largest producer. And it very well could be in the future OPEC. So, or I should say Saudi Arabia. So if we are at Hubbard's peak, we could see the peaking of the world because the majority of new oil production came from shale oil. Warren Pies, he says, residential construction industry added 2,400 new workers in May. This is going to be a long cycle. What is he talking about? So let's go down here. It says, new report out updating our housing recession model. Reminder, residential construction payroll declines. They lead the recession. I look at the housing starts. The housing starts start to decline, and then residential construction payrolls start to decline. That's kind of the sequence of events. These guys, 14 Research and Warren Pies, they know what to look at. I'll just say that. It says, once housing jobs draw down by 8 to 10%, a recession begins. There is your leading indicator. This is what you are supposed to be looking at. Our updated housing model pushes its predicted recession timing from November of 2023 to February 2024, at least with their predictions. It says, once a residential construction declines 8 to 10%, a recession begins. That is where your unemployment comes from. It's not the tech layoffs, in my opinion, at least. It's from the residential construction declines. And right now, we've added 2,400 new workers in May. It's still going up. It's going to be probably a longer cycle than what these guys are even predicting. They may be even off by 2, 3, 4, 5, 6 years, depending at least on the construction cycle. That's my take. I think we could easily have 3, 4 years of really strong construction, maybe even out to the end of this decade, which is possible. So that puts it at 2027. And I know a lot of people are looking 2027, 2028, maybe even 2030. We've had a longer, elongated downward cycle. We'll call it the recovery phase was a lot longer. And it was about 11 years. So we could see an 11-year upcycle as well. And we've had an upcycle for maybe 2 years into it or something like that, 2, 3 years. Maybe we go all the way out to 2030 or something. I don't know how fast we can build the homes. It all depends if we have a slowdown in the short term. It depends how fast we can build them. they're going to continue to add workers, at least ones that can build, hopefully, until we get maybe up to 2 million homes a run rate, and we have to do that for probably 7 to 10 years. That's how underbuilt we are. So coming on down, we've got the average price per square foot in Slovakia is approximately $250. USA is $222. The average salary in Slovakia is around $18,000 per year. The median American worker brings home an estimated $54,000 a year. 93% of Slovakians own a home versus 66% of Americans. Go figure. I just thought that was interesting. We are cheaper on a per square foot basis, make a whole bunch more money, and everyone keeps saying housing's unaffordable. It's unaffordable. Housing is just the pricing is a function of supply and demand. It's really what it is. And obviously this is showing you that affordability is a lot less affordable around the world than America. America is actually one of the most affordable places to buy a house in relationship to the median salary. We're not paying up as much as a lot of different areas like China, Australia, New Zealand, Canada, basically everywhere that you can think of outside of third world countries. Coming on down, we've got today's yield curve is the most inverted since the 1980s. Yield curve inversions systemically lead to higher unemployment rates. I don't think that is a accurate statement. I'll give you what I think is accurate. What I think is accurate is you get a yield curve inversion, and then that yield curve inverts because of the housing market, generally speaking. It's inflationary. So you get this inflation, it pushes it down to a level, then you get some sort of an end to that yield curve inversion. The yield curve inversion is just an inflection of where you are in the cycle. I don't think it necessarily determines a recession. It's an indicator that happens before a recession occurs. It doesn't predict, it doesn't do anything. It just follows wherever you are in the cycle. So if the cycle lasts longer, this can invert for a good long time. I think it highly depends on the interaction of the demographic with the housing market, how messed up that is, and how imbalanced or out of balance that we'll call it the fragility, how fragile the housing market is at the time that this yield curve inverts, put it that way. If we've got a large supply-demand imbalance, I think the curve will stay inverted for a long time. That's my guess. We have the largest housing market imbalance that we've ever seen in the history of America. That's also why we see one of the most unaffordable times to buy in history, because we have such an imbalance in that market. We also rocket launched interest rates up at the same time, but I think that's basically a reflection of the imbalance of the housing market, is yields going up. Hence, the inversion of this curve. We're also seeing unemployment stay very low. The unemployment will stay low as long as we have to build a buttload of homes. And that's what we are looking for in that construction cycle. The construction cycle is what moves a lot of these cycles. This here is the unloading of the construction cycle, and this is the reloading of the lowering of interest rates to basically turn it into another housing market. Here, we've got low unemployment, and I also think that construction cycle is going to be longer than what most people think. But again, we'll watch all of the numbers, and we can see all of this kind of develop over time. Even substantially higher rates can't stop this freight train. It's amazing. It says this is a crazy chart. Canadian consumer spending as percent of GDP. Canadian consumer spending at an all-time high. Why do you think that, guys? I can tell you why. So Canada's going through a massive housing boom as well. I think they've got a lot of immigration up there. They also have a demographic coming into home buying years, which is a little bit larger than before. So it's pushing the price of everything up. And it's not just pushing the price. It's people going through their life at peak spending years. It's when you have babies. It's when you buy a house. It's when you buy furniture for the house. You have to buy more food, more diapers, more everything. Canadian consumer spending at all-time high. Yeah, if your demographics coming in and you've got a bunch of immigration going on, I mean, yeah, it's going to go to all-time highs. It's probably going to surpass that. And that's household expenditures as a percent of real GDP. So yeah, I think that's all coming and all hitting at the same time. Here's Justin. This guy's from Fidelity. He says the rising estimate for the terminal rate of the Fed's rate hiking campaign is nudging the dollar higher again. And it's showing the USD. And I also saw this. I saw this as a double bottom here where we could actually break to the upside for a little bit. So thought that was interesting. Investor purchases of U.S. homes fell 49% over the last year, the largest year-over-year decline on record. But that's investor purchases, and that's the year-over-year growth. So, yep, some investors are pulling back in terms of U.S. homes. That's investors, though. Now, self-made real estate millionaire Barbara Corcoran says it's a good time to buy because home prices are going to explode when mortgage rates drop. I've said that before. Maybe she listens to the channel. Probably not. But yeah, I said the housing market's real tight. And if interest rates were to drop, your affordability would go up. I know a lot of people that are waiting to buy homes, waiting for that mortgage rate to drop. The problem is there's a lot of people that are waiting for mortgage rates to drop. So I agree with her. A good time to buy is when the rates are high and you can refinance if the mortgage rates go down. If the mortgage rates continue higher, then you bought at a good time and you bought it when the rates were a little bit lower. I always try to maximize whatever I think's the best time to buy the best house for me and then try to lower payments later. That's what I did with mine, but I bought at a pretty good time, and that was some years back. And maybe some years ahead, people will look back and say, wow, today's a really good time to buy. But again, that's not any advice or anything like that. You have to do whatever works best for you and your family and your situation and whatever you can afford. But that's her opinion, at least. Here's one. It says, a long view on equities. I think we are in the twilight, but not the end of this secular bull market. If the secular bull started in 2009, which I think is a legit starting point based on the deviation from trend below, then at 14 years old, this is so far shorter than the last two, 82 to 2000 and 49 to 68, which would make the next few years a fitting twilight. The only thing I'll say here, guys, is in these stock markets and a lot of these things, if you have a real inflation rate, because I think they understate it, if you have a real inflation rate of like 5 or 6%, and you have a return on the stock market of, say, 10%, and you have to pay taxes on it, what exactly is the stock market doing? Like, what gains are you actually leaving the table with? If you got 5 or 6% inflation and you have to pay tax after 10%, let's say you net 8% and inflation 6%, you barely make any money, any purchasing power gains after the real rate of inflation. If that inflation is going into other assets at a faster pace than the stock market, then obviously you're underperforming and you can't buy more of those other things. You're losing purchasing power. The best thing you can do is go buy the things that you need and just hold on to them to some extent. I'm not saying that is the case at this time, but I think it will be in the future at some point, where it's going to be hard to outpace commodities and other real things. This is the manufacturing construction spending going parabolic, with year-over-year growth climbing to 104% as of April. Construction spending going parabolic. Holy crap, guys. This is also a function of jobs. It's also a function of what we're talking about in terms of construction. So that's manufacturing construction. And one thing I can just click this here. Someone said, what's driving this? The Inflation Reduction Act, infrastructure funds. I would suspect that's what someone had said back here, but I don't know. This thing's it's flying higher. It's probably deglobalization going on or something like that. Obviously, I posted that. Tavi says the U.S. will need to refinance almost half of its national debt in less than 2 years. Wait, whoa. The U.S. needs to refinance almost half of its national debt in less than 2 years. Let's not forget that interest rates were just 0% 15 months ago. Wait until these debt instruments need to be rolled over at 5% rates. One thing is true, none of us own enough hard assets. So this is the marketable government debt by maturity and percent of total. This is 01, 2023, 02, 03. So look at US. Almost 50%, 45% is, what is this? In 0 to 2 years, almost 50%. That is crazy, guys. Look at all that debt that needs to go. That is ridiculous. And even 2 to 5 years, it's another big chunk here. So, I mean, over 50% for sure if you add the two together, 60-something percent. What does he have here? Almost half, but a good chunk is 5 years. I don't think the housing market's going to be through by then. So I don't know how they're going to manage this. They're going to have to manage it by doing quantitative easing and printing money, and I don't know what else they're going to have to do to manage that, guys. That's crazy. And that's what I've got for today, guys. So I'm going to end it there. Yeah, that's what we're looking at right now, and that's what's being shared. The construction cycle is obviously quite strong, adding a bunch of employment. We've got a bunch of other information that I shared today, but if you guys like the content, give me a thumb up, subscribe to the channel, subscribe to the website if you'd like. Love to have you a part of the community. And don't forget, we've got a 5 p.m. Mountain Standard Time question and answer session on Sunday for the members. I'll see you guys there. We'll catch you next time. This is Finding Value.